As of the close of the regular market session on August 6, 2026, the stock market is closed, and Keel Infrastructure Corp trades at exactly $3.82 per share on the NASDAQ, down 11 cents or roughly 2.80% for the day. During the session, price action fluctuated between a daily low of $3.71 and a high of $3.96, against a backdrop of roughly 23 million shares changing hands. While the headline index trackers might show a modest single-day drop, the broader reality under the surface tells a dramatically different story. Wall Street treats this company as just another volatile penny stock riding the coattails of computational trends, but institutional order flow suggests something far more calculated is taking place behind closed doors. Most retail traders watching their mobile feeds see a struggling ticker that keeps bouncing around single digits, assuming it is tied strictly to the wild swings of the crypto market. The deeper financial reality reveals a massive corporate pivot toward high-performance computing and artificial intelligence data infrastructure, backed by locked-in power interconnections that traditional tech giants would pay top dollar to secure. When you log into your preferred retail platform, whether you check your holdings through the Robinhood app, scroll through your portfolio on Interactive Brokers, or monitor order flows on the Fidelity trading platform, the surface numbers can easily mislead you. Wall Street loves simple labels. For years, investors lumped this ticker into the speculative basket of digital currency miners, assuming its financial health lived and died by hash rates and token values. That expectation remains deeply ingrained across message boards and casual trading forums. The reality, however, is that Keel Infrastructure Corp has spent the past few quarters quietly engineering one of the most aggressive structural transitions in the energy and digital infrastructure space. They are not just running servers, they are leveraging secured power contracts and grid access across key North American regions to build high-density compute facilities capable of supporting heavy enterprise AI workloads. If you examine recent market mechanics, the sheer volume over the last month highlights an intense tug-of-war between short-term momentum traders and patient institutional accumulators. When retail accounts using Robinhood stock trading or SoFi active investing see a sudden 10% pullback, the instinct for many self-investing accounts is to panic and cut losses. Yet, if you track the block trades and institutional reporting on the Interactive Brokers platform or inside a traditional individual brokerage account at Fidelity, you notice that major asset managers have been holding their ground. They recognize that power, not raw hardware, has become the primary bottleneck for technological expansion. While high-flying mega-cap names like NVIDIA stock and Apple stock capture the headlines, the physical backbone required to run those massive machine learning models depends entirely on companies that possess actual megawatts ready to draw from the electrical grid. Keel Infrastructure Corp sits directly on top of a massive 2.2 gigawatt project pipeline with established grid interconnections across Pennsylvania, Washington, and Quebec. Look at how the stock has behaved over the recent weeks leading up to its upcoming financial disclosures. The equity experienced sharp swings, moving from lows around $2 earlier this year up past $6 before pulling back into the $3 range. This level of volatility scares away conservative accounts managed through Schwab Intelligent Portfolios or conservative fixed income portfolios held in Fidelity IRAs. But for active traders utilizing SoFi Invest, SoFi stocks, or Robinhood investments, these price swings represent high-volume trading opportunities driven by broader sector re-ratings. Every time interest rates fluctuate or broader tech indices experience profit-taking, small-cap infrastructure tickers get hit first. The expectation is that high-debt, capital-intensive firms will crumble under elevated borrowing costs. The reality is that Keel Infrastructure Corp has been actively managing its capital structure, utilizing strategic offerings like convertible notes to reduce immediate equity dilution while securing the long-term cash needed to fund power substation build-outs. To truly grasp where this stock is going, it helps to understand where it came from. Originally operating under the banner of Bitfarms Limited, the company built its foundation as a low-cost Bitcoin miner operating across regions with abundant, cheap hydroelectric power. That legacy business provided the initial footprint, but management realized that relying solely on volatile block rewards was a dangerous long-term strategy. They rebranded to Keel Infrastructure Corp to signify a permanent shift in corporate direction. Instead of just processing crypto transactions, they began converting their power capacity into multi-tenant data center campuses built for high-performance computing. Their operational footprint across sites like Panther Creek and Scrubgrass in Pennsylvania, Moses Lake in Washington, and Sherbrooke in Quebec gives them a geographic distribution that takes advantage of distinct regional power markets. This operational pivot means they can sell computational power directly or lease infrastructure under long-term agreements, replacing unpredictable daily mining payouts with predictable, high-margin contractual revenue. Comment below how many shares of Keel Infrastructure Corp you currently hold in your portfolio and whether you are holding for the long run or trading the short-term swings. When people evaluate online investing choices on investing sites or seek investment help for self-investing strategies, they often compare small infrastructure plays against established giants. Investors who traditionally hold safe index funds or Fidelity mutual funds might overlook a stock trading under $5. However, when you analyze the sheer cost of acquiring grid interconnection rights today, the narrative changes completely. Building a new data center from scratch can take 3 to 5 years, largely due to regulatory hurdles and grid capacity constraints. Keel Infrastructure Corp already has those interconnections active and energized. This gives them a distinct time-to-market advantage when hyperscalers come looking for immediate capacity. This exact dynamic creates a stark gap between what retail investors expect and what institutional players are pricing in behind the scenes. If you look at how people manage their wealth across platforms like the Robinhood mobile app, SoFi Active Investing, or Interactive Brokers Trading, there is often a rush to buy into high-priced tech leaders like Tesla stock. But true wealth building through Invest Online tools often involves identifying the suppliers and backbone providers before the market fully credits their corporate transition. The market currently prices Keel Infrastructure Corp with a heavy discount because of historical quarterly net losses associated with legacy crypto write-downs and restructuring expenses. The reality is that as legacy liabilities clear and long-term hosting or AI compute leases begin contributing to top-line growth, gross margins have the potential to expand sharply. Revenue has shown strong quarter-over-quarter expansion in recent reports, even as net income reflects the accounting friction of a massive operational shift. Looking ahead, the market setup for this stock hinges on execution over the next few quarters. If management successfully converts their multi-gigawatt pipeline into active, revenue-generating high-performance compute centers, the stock could undergo a fundamental re-rating. The key risk factors investors must track through their Interactive Brokers account or Fidelity Wealth Management portal include potential power regulatory changes in regional markets, execution delays in facility upgrades, and general macroeconomic volatility that could tighten credit conditions. If power costs spike or capital markets dry up, the company could face friction in scaling its footprint. On the flip side, the opportunity lies in the unrelenting global demand for AI compute capacity. Major technology firms are scrambling for power, and Keel Infrastructure Corp sits right at the intersection of energy access and digital infrastructure. The central takeaway is clear. The market expectation views Keel Infrastructure Corp as a speculative, low-priced stock weighed down by its past crypto ties. The actual reality is a company undergoing a deliberate structural transformation into a high-density power and compute provider with tangible assets in high-demand energy markets. For self-investing accounts using an intelligent portfolio, Robinhood fractional shares, Fidelity ETFs, or SoFi robo-advisor allocations, understanding this gap between sentiment and fundamentals is essential. Whether you execute trades through the Fidelity mobile app, SoFi trading platform, or Interactive Brokers platform, platform, keeping a close eye on grid interconnection milestones and lease announcements will tell you far more about this company's true value than daily noise on the price chart. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.